Hi everyone, I'm Matt Wheeler with Wheeler Accountants. We really appreciate this opportunity here to present to you guys today on some tax updates and strategies targeted towards real estate professionals. We hope you find the presentation informative and a little bit entertaining too. I know that a lot of times the Q&A portion is the most valuable piece, so I want to make sure we have time for that. So we are going to try and get going here. Presentation is not too long. I think if you have questions as we go, you can enter them in the chat screen there, and we can try and address them towards the end of the presentation when we get into the Q&A section. So feel free to put it in there. And I got my associate Nick Satterfield with me here also, so Nick will be chiming in on pieces of it as well. And thank you, Alan, the man, for helping set this up and giving us the opportunity here.
Oh, thank you. You guys have been great. Matt and team have saved me a lot of money. So hopefully you guys can also benefit from all that knowledge that Matt's going to share.
So I'm going to share my presentation here. All right, so we're going to cover some best tax practices for real estate professionals today. Just a little bit about us. We're Wheeler Accountants. We're full service tax and accounting firm here in Silicon Valley. We have 2 offices. Our main one's in San Jose. We also have one in Watsonville, a little south of Santa Cruz. Full service means we offer accounting services for businesses, tax services for businesses and individuals, and we do financial statement audits and that sort of work too. We have over 3,000 clients in total, most of them located in the Bay Area, but all over California, the nation, and the world. We're a member firm of CPA America. It's an 83 member accounting association, so 83 different member firms across the country, and it gives us access to firms across the country for specific, state issues we may encounter, as well as access to Crow Global. Crow is the top 10 national and international firms, so we have the ability to call on the big boys if we have some really complicated stuff that comes up and use that through our network. We're also one of Inside Public Accounting's top 400 firms in the nation by revenue, so we're number 366. And one thing not on here I did want to mention that might be of use is we have a podcast for our firm, but I also have one separately I'm doing with the financial advisor called the Avocado Toast podcast. It's targeting millennials, Gen Z, and what we call Henrys, high earner, not rich yet. So you may be encountering these folks trying to buy homes or know of other folks in the area. It's a free podcast, free advice, kind of targeting the DIY folks who maybe can't afford to hire a CPA or someone yet, but do need to have general financial and tax advice, and encourage you to check it out. It's on Spotify, iTunes, all those places. We're going to start by covering business expenses, and actually going to have Nick take this piece here and go over some of the common business expenses you're going to see as real estate agents.
Yeah, so as Matt said, these are some of the common expenses. There are plenty of other expenses, but some of the ones that we see most common for agents and for developers are advertising and marketing, getting the house on the market and putting your name out there to get more clients, any commissions being paid out, internet and computer expenses. So anything basically that can also include your phone. If you have a Verizon bill, you can expense some of that. Home office expenses. If you don't have an actual office for your business and you work mainly out of your home, you may be able to deduct a portion of your mortgage interest, your property taxes, utilities, garbage expense, maintenance. So quite a few things that you can actually take into account for your home office expenses. So that's one thing that I've noticed, and I'm sure Matt's noticed, is a lot of people, real estate agents, any real business may be missing that portion, and it can add up to a significant amount depending on what your income level is or the amount of mortgage interest and property taxes you pay. Other items include subcontractors or contractors for repairing the house. Some of those may need to be, depending on if you're a real estate agent or if you're flipping properties, some of those may need to be capitalized expenses. Some of them may just be expenses. There are some rules about below $2,500 is kind of one of the thresholds you can look at for whether or not you may need to capitalize and depreciate, or whether you can just take the repair as an expense. Other things include staging, trainings, any trainings that you do, or any assistance that you may hire. One thing to kind of be cautious of on assistance is that you may need to consider whether they're going to be a 1099 employee or whether they're going to be a W-2. That is something that is kind of a gray area, but we typically recommend going to an employment attorney at times, just to make sure you're on the right path of issuing a 1099 or issuing a W-2 and actually hiring them on as an employee. Matt, do you have anything to add to that?
Yeah, AB5 is the rule there for classification as a contractor or employee. That came out a year or so ago, 2 years ago. It's a big deal, obviously, if that's what the whole Uber Lyft proposition was about on the ballot recently. California pushing very aggressively for people to be treated as employees and not contractors. There's obviously special industry carve-outs. So, you know, yourselves as agents are one where you can be 1099 contractors, not employees, but often people like an assistant may not qualify under that. So you got to be a little careful there. Classification is important for a lot of reasons. Some of them we'll touch on later, including like how some of your retirement benefits work and what you can do there. But it's just important to pay attention to if you do hire an assistant. There's a good chance they may be an employee, and if they are, you got to abide by all the employment regulations, paying hourly or overtime, or having a minimum salary above the minimum wage and that kind of stuff. So it's definitely a trap for the unwary, I would say. And this is certainly not a comprehensive list of expenses. This is just some of the common regular ones we see for agents. And we'll get into some of the other bigger ones here in a second, which I think are important to make sure you're doing correctly. So let's talk about audit red flags a little bit here. This is always a kind of hot button issue people are concerned about. There are some common red flags that can put you a little higher risk of an audit. So it's really important to be aware of them. Number one I have on here on something to avoid is what I call like outlier expenses. And this is something that, you know, the IRS gets records from all across the country and people's taxes. You fill out a business type code, like a business NAICS code on your Schedule C if you're a, you know, self-employed sole proprietor, for example, for a real estate agent. So they compare that across all the Schedule Cs filed, and they kind of make sure that your expenses are in line with your income level. And if they swing two-way one way or the other, it kind of flags you a little bit as having a higher audit risk because it looks unusual compared to the averages. And one of the advantages working with CPA firm like us, or some other firms probably have it too, but our software will have a form in there that gives us some analysis. Usually the information is about a year or two behind because we don't have the most recent information from the IRS, but it'll take your income level there, your gross receipts, and then it'll show us what the averages are based on percentage of income, what your expenses should be and what you're showing. And it'll kind of show us if we're showing way out of whack on a certain expense or not. So sometimes this is just as simple as how you're classifying the expenses and remapping them a little bit to fit in better categories so you're not looking crazy out of whack on something. But those are some of the kind of things that can cause an audit that you want to avoid. And so paying attention to that is really important. There are some high risk expenses I say to avoid. You don't necessarily need to avoid, you just kind of got to be aware and not push the button too much. The common ones I see are meals and entertainment, of course, are a big one. Entertainment now no longer allowed under federal rules with the passage of the Tax Cuts and Jobs Act, the Trump tax laws at end of 2017. So we no longer have an entertainment deduction for, you know, taking a client golfing or some of those kinds of things, but you still can deduct meals and that kind of thing. So meals are definitely still allowable up to 50% of the cost. Entertainment's allowed for California, but not for federal. So there is an adjustment there where you can add some of the expense on the California side, and something that gets missed quite a bit. But again, kind of like with the outlier thing, we want to pay attention to how much we have here as compared to the total receipts and make sure we're not going too out of whack. And we try and make it reasonable too. You know, a lot of times I remember sitting in my office on many occasions talking about a client. They say that their meals and entertainment are, you know, 15,000 a year or something. I'm like, okay, well, let's play around with that a little bit. So that's, you know, over $1,000 a month. That's somewhere X number a week. It's, you know, how many times a week you're going to dinner, right? And we kind of do the numbers and play with the calculator on the 10 key there, and it ends up being maybe too high or too low or whatever. And we need to kind of scale it back a little bit. So there is some strategy there to make sure you're not getting too crazy, and it does make sense. Sometimes they're too low, and if you're not keeping good records, we'll talk about in a second, you might want to raise that number a little bit. So again, it's all about just looking at it compared to the revenue and making sure it's in line with industry averages and that sort of thing. Business vehicles on here. We don't want to necessarily avoid business vehicles. It's an excellent write-off for us, but we want to avoid things like having 100% business use on our vehicle, because that's a little bit of a flag for the IRS. So when they see 100%, they start to question it a little bit. You know, you're telling me you don't have any commuting, or you don't go to the grocery store occasionally with your car. That's the kind of stuff the agent will ask us. So typically, I know agents are driving around significantly and a lot, so we're going to have a high percentage on the mileage that's business related as compared to the total, but we usually don't want to push it all the way to 100. So something in the 80 to 95 range is usually a more reasonable thing, unless you truly are incredibly diligent about having that second business only pure vehicle. You never pick up the kids from school on the way home from something. You never go to the grocery store with it, any of those kinds of things. Then you could, sure, you could go 100, but usually that's not the case. So we want to make sure we pick something that's a little more reasonable there. And again, the other kind of audit red flag area a little bit is the home office. Once again, we don't want to necessarily not claim that expense. We just want to make sure that we're not getting too aggressive on it. You know, making sure you do the measurements right and that we're taking the appropriate proration there. We can take, you know, the amount of square footage dedicated to the home office area divided by the total square footage of the entire home. That's our proration percentage. We're going to apply that against all the expenses for the home, the mortgage interest, the taxes, the utilities, the security, HOA if you're paying that, gardener, cleaner, insurance, you know, all these common expenses that we can go in there. But one of the big things is that percentage, making sure we're doing it, you know, at a reasonable number and it's not too high. And if it is, it may be a red flag. Just be prepared to defend yourself under the audit and have good records. So let's say you get audited. Now what? Practically speaking, especially the last 4 or 5 years, the audit risk is pretty low. Gonna knock on wood, but it's very low. The IRS has been understaffed. They haven't had the ability to audit as many taxpayers as they used to in the past. We haven't seen a lot of audits, but it does happen. So there are some common best practices to have a real smooth resolution in the audit. Number one, you want to have really good documentation and record keeping. I really can't stress enough how important it is to have everything nice and clean. You're going to get an auditor assigned from the IRS who's going to come in, and you know, this is a person, they have lots of cases on their schedule, and if your stuff is nice and neat and ticks and ties and balances to the return, they're a lot more likely to breeze through that thing, go to a no change, and they're going to move on to the next case, right? If you give them the box of receipts and you start playing hardball right away, and you're not doing anything for them and nothing matches, then they're going to start, they have to dig, they got to do work. And then the more time they're spending on it, the more they need to justify why they're spending so much time, they're going to start finding things because they got to get a payoff to justify spending all this time on your account. So you want to have really good documentation and records to make it a smooth audit. And you can often avoid some of the bigger issues on the audit that may be more of like a aggressive position because you are in such a good place. And I've had a lot of real life examples that hold true to this, which, you know, show that having good records is important. Part of having good records is having separation of personal and business expenses. So you really need to keep those two things separate. We usually recommend that you have a personal bank account and a business bank account. Everything business is run through the business, everything personal is the personal account. Furthermore, you know, you probably want to have some credit cards to earn points and rewards and that kind of thing. Have a personal credit card, have a business credit card. Sometimes we even have a third credit card where it's business, but maybe a little more gray stuff, and we can go over that together as the CPA and the client to kind of decide which of that stuff we want to take and take as a deduction. But it's really important you keep personal things purely personal on the personal card and business things purely business. It makes it really easy. If you commingle funds and everything else, then you're trying to go through all the records and pull out the stuff that's business only. You know, the IRS, the lines are more blurred and they're more likely to consider things maybe personal and rather than business. But if you can show here, oh, no, I'm very good about keeping track of these things, Mrs. Auditor, and here are all my personal dinners, and these ones were with my wife or whatever, or my husband, and these are personal nature. These ones are pure business. These people I met with, you're in a much better place. And then, again, they're going to spend less time going on it. So I had an audit one time for, this wasn't a real estate agent, but this guy had some property up in Idaho, and it was going to be for like an outfitter, backpacker, hunting type business thing, but it was just basically land and building. And he's got a little bit of income from like crop income, so he sold hay or something, $500 or $600 a year of income. This guy is a venture capitalist, so he's going to his property in Idaho, flying on his private jet a couple times a year. So we got a lot of travel expense. We got some other expenses associated with the business there, and he gets audited. And I'm like, okay, we got a brace here. They're going to bring up the hobby loss rules where they're going to say this business is not really in it for a profit. We got to justify everything, get a memo ready on why you're going to make a long-term business out of this, the whole thing. And I'm going to save it. I'm going to use it if I need to in the audit. And also let's gather all the expenses, put it together, make sure everything ties out, present to the auditor. Well, the auditor comes, his assistant had like a fantastic binder with all of the expenses subtotaled on a ledger. Then the backup was behind it for each invoice and receipt and proof of payment. This tied to everything we had on the return beautifully. And, you know, I give the binder to the auditor, explain a little bit about the business, explain the income source of the hay sales or whatever. And she goes into her room and starts working. I check back on her like 3 or 4 hours later, ask how it's going. She's like, oh, it's great. Everything's really organized. Thank you very much. I'm a little unsure if we have this income number on the right line for the hay thing here on the form. So I'm checking to make sure it's on the right line. I'm like, okay, you do that. You keep checking, make sure we got it on the right line. I want to make sure we got this thing correct, you know? I come back, check in an hour later. She's like, okay, I'm done. It's great. I'm going to recommend a no change. Everything matched. I really appreciate it. Thanks a lot. No change goes to the manager. That's just a rubber stamp on the manager's desk and that audit's done. So the hobby loss thing didn't even come up. That's always my gold standard story on being really prepared and organized for the audit, how you can breeze right through and they don't necessarily ask a lot of questions on some of the more, you know, aggressive positions you might be taking. So again, it's really important to be organized when you're going with the IRS, and that matters a lot, and the strategy thing with the auditor too. Last bullet point on here is considering the state impact. If you do have an adjustment on the federal side on an audit, don't forget that they're going to report that automatically to the state franchise tax board, state of California. You have to amend your California return too. So that gets forgotten a lot. And then you get a bill about a year later for the extra tax you had to pay on California that you already had the extra income on federal. So if you do get audited, if there is an adjustment, then don't forget about the state return as well. Or if you're negotiating something with the IRS on how much expenses to give away or something like that, you know, keep in mind you're also negotiating that you're going to have a state tax bill with that as well. So you're not just talking about federal tax. And if you're in that position as well, there's a lot you can do around arguing out penalties and that kind of thing, which is very important. If you play nice, if you provide good stuff, you're more likely to get them to waive penalties and that sort of thing. Your risk is only down to the tax and then interest. They can't waive interest by law, but they can with the penalties. Sole proprietor versus S corporation. This one also comes up a lot. We get this question all the time. When should I form an S corporation? What do I need to keep in mind? There's a few things I always bring up with clients on this level. Number one, income level is real important. If you are just starting out or don't have a lot of revenue in the business, then S corp may not be worth it. We can help run an analysis to kind of figure out which is better. We do a kind of pros and cons of each Schedule C versus S corp. And we take a lot of things into consideration, but income level is one of the big ones. My general recommendation, until you're hitting a net after business expenses of maybe 200 to 250, it's probably not worth looking at an S corporation because you're going to have a lot more cost of the S corporation and you may not see a lot of the benefit yet. So once you kind of get above 200,000 or so of net income, now we're looking at an area where we can maybe do something with the S corp that's going to be a lot more advantageous than the C corp and make the Schedule C or sole proprietorship and make a lot more sense moving forward. We get a lot of myths about corporations and entities in general and when should I form one. Number one is people sometimes think that forming an entity performs some magic trick that now converts non-deductible expenses to deductible, and that's just not the case. The tax rules for what's deductible or not don't necessarily matter whether you have an LLC or an S-corp or you're a Schedule C sole proprietor, so it doesn't change anything like that. If you're going to switch, we want to make sure that it's going to be more tax advantageous net of any additional costs. And there's also liability protection there as well, which this is more of a legal question, of course, but you know, there is that liability shield of having an entity, which you don't have when you're a sole proprietor. That being said, a corporation or LLC is not going to pay your legal bills if you get sued. So it's just going to protect your assets from, you know, a judgment against you. So you still want to make sure you have really good insurance, you know, E&O type insurance, and the number one liability protection thing you can do is avoid working with shady people that are going to end up suing you. So pick your clients very, very well. That's always the first rule I was told by an attorney. I thought it was a good advice. Advantages of the S-corp. So the major advantages of the S-corp, number one is as a sole proprietor, you pay self-employment tax on all of your income as a sole proprietor. So that's the employee and the employer side of Social Security taxes and Medicare taxes. Social Security is capped at 137,000 of income or something around there, and you pay 6.2% on each side, so 12.4% on that. And then Medicare tax you pay on all of your income as a sole proprietor, all the way to infinity. So there is no cap on Medicare tax, and you pay that all the way. With an S corporation, you're forming a separate entity running all your business through that. You're going to have to hire yourself as an employee of the S corporation. So you're going to pay yourself wages via W-2 on payroll, and you're going to pay payroll taxes on that. So you'll still pay Social Security and Medicare taxes when you're an employee of the S corporation. But the advantage of the S corporation is that you don't have to pay out all of your income as wages. So we need to just pick a reasonable salary. That's what the IRS tells us. And we want to pick the lowest reasonable salary you can get away with and have the rest of the income paid to us from our S corporation just flow through, because it's a pass-through entity. So the income will flow through to your personal return, and you'll pay income tax on it still, but you will not pay the Medicare tax piece on it. Or if you're under the 137,000 or so W-2 income, you'll escape some of the Social Security tax as well. So one of the biggest advantages of the S corporation is that Medicare tax savings that you can get. Another advantage that's a little less quantifiable, but nonetheless I think important, there's a little bit less audit risk on an S corporation than there is on a Schedule C. The audit rates are, I believe, less than 0.5% on S corporations. They're pretty low. Individual returns also are not audited very much, but it's more than that. And a Schedule C on a 1040 return gets audited even more than the regular individual return. Most IRS audits of individual returns focus on Schedule C. So you're probably in the highest audit risk category as a high earner Schedule C on your 1040 when you're a sole proprietor. So having the S corporation and all your business activity run through there is going to be a little more advantageous for you in terms of lower audit visibility and risk. Again, they haven't been auditing a lot the past several years, but that's going to swing the pendulum back at some point, and I'm sure they will. And you know, no one likes, even if you win an audit, you lose because you're paying me to defend you. You know, you're paying an accountant. So even a no change is still kind of a loss. Another advantage of S corporation, and we'll talk about this a little bit later too, is under the Trump tax laws, the Tax Cuts and Jobs Act, there was a 20% pass-through deduction that was passed. It's called the pass-through deduction. It's called qualified business income, or QBI. It's basically the 20% deduction. And there's different levels at which it comes into a play. If you have below $315,000 or so of joint taxable income as a married couple, you get the 20% deduction no matter what on any of your QBI income, any of your qualified business income. So a Schedule C, you're going to get it. S corporation income flowing through, you're going to get it. That's all great. But if you start to go over that amount, if you're going over 415,000 of joint taxable income, or you're in between 315, 415, different rules come into play. There's limitations on the QBI deduction. One of them that's important is that you're limited to the lesser of 20% of the QBI from the company, or you're limited to either half of the W-2 wages you're paying the company, or a quarter of the wages, and this calculation based on the depreciable assets within the company. For our purposes here, we'll just go with the W-2 limitation. So you're limited to half of the wages you're paying in the company. But if you're self-employed as a sole proprietor and you have no employees, your wages are zero. So that means your QBI deduction is going to be zero if you're a high income taxpayer, or if combined with your spouse, you're a high income taxpayer over 415. And you're going to miss out on the entire 20% deduction. If you do the S corporation, you have to pay yourself a salary as a W-2. You're paying W-2 wages. Well, now you have some W-2 wages. We don't get QBI on the wage piece, but we do on that pass-through component. And so now when we do that, we can actually create some QBI and get this 20% deduction that you otherwise would have lost out on. And there's a magic number. It's like 27.5 something percent or whatever. If you target that number as your wages at the end of the year compared to the overall income, that maximizes your benefit, because higher W-2 income decreases the pass-through income, so you get less 20% benefit. Lower W-2 income decreases that limitation amount you can get on the 20%. So that like break-even magic numbers are kind of between 27 and 28% of wages. And that's, we'll look to kind of bonus that out at the end of the year or something when we're doing the tax planning, things like that, to make sure we're maximizing on the 20% deduction. Disadvantages of the S corporation, of course, there are disadvantages. It's more complexity. You have to have full books and records. You got to have a balance sheet, because we have to file a balance sheet on the return. So you can't just do kind of like the Excel spreadsheet of expenses anymore. We got to have double entry accounting. You might need to use QuickBooks, something like that, to have full financial statements. There's cost. You're now paying someone to file a corporate return. That may run a few $1,000s a year for the S corp return, or depends how good the shape the books are in, that kind of stuff, and other things you have going on, but that's going to be additional cost as well. You're going to have payroll costs if you have no employees as a sole proprietor, but then you add employees, even yourself as the S corporation. Now you have to pay a payroll servicer to run payroll and do all payroll tax returns, everything else. So you got some cost there. There's an S corp minimum tax, so it's the greater of $800 per year minimum tax, or 1.5% of the flow-through income on the S corp for California purposes. So there's some extra California taxes, but there's no additional federal taxes. And there's some corporate formalities. So if you form a corporation, you have to do board minutes and a lot of those kinds of things to make sure you're keeping up with your corporate formalities. Otherwise, you run the risk of, quote unquote, someone piercing the corporate veil if you get sued and that kind of stuff, because you're not treating it as a proper business entity. So a little more work there. My understanding, you can get around some of that because you can actually form an LLC and elect to be taxed as an S corporation for tax purposes. But under state law, you're an LLC, so you don't have all the board minutes and that kind of stuff requirements. But generally speaking, you have a little more work on the S corporation. So as I said in the beginning, we'll help run the calculator and see which one's more beneficial. And that's why you can kind of see us saying, you want to have around 200 grand net income before some of this really makes a difference, because you got all these extra costs and fees with the S corporation. But if it works and you're high income, you're going to be saving 4 or 5 figures a year in tax, or even more depending on how much you're making with the S corporation. So it can be very material to do so. I'll let Nick take this one here, since I've been talking for a while, on the benefits of keeping a P&L.
Yeah, so there, as Matt's mentioned a few times throughout this presentation, there definitely are benefits of keeping clean records, a profit and loss, a balance sheet, not just if you're an S corp, even if you're just filing a 1040 with a Schedule C. One, it will make it easier for you to prepare your tax return when you're getting to that, because you won't have to go backtrack the last 12 months to figure out what expenses you have. And also, it will make sure you aren't missing expenses. If you're going back 12 months, if you're come April 15th and you're trying to file your return, if you're having to go back all the way to January of the prior year, it's likely you're probably going to miss some expense somewhere. So making sure you do a monthly, a quarterly P&L or balance sheet will help to ensure you're not missing any expenses that could help lower your tax. along with that, if you are keeping a monthly, quarterly P&L, it will let you analyze and see where you're spending too much money, or maybe where I'm not putting enough into advertising and marketing, and maybe that analyzation will help you grow your business and be able to either bring more money in or save some money if you're spending too much on rent and can find a building to rent cheaper or something else. It will also allow you to project through the rest of the year. So one thing we like to do with a lot of our clients is we take, for example, June's financial statements. We take June's P&L, and then we can extrapolate those to the end of the year and kind of project to see what net income is going to look like. We can also say, how many houses are you going to close on through the rest of the year? What do you expect your income to look like? And we can take that into account rather than just extrapolating, basically multiplying by 2 in that scenario. We can take into account your exact situation, and you may say, okay, I'm expecting $200,000 of commissions through the rest of the year. We can take that into account and use that in our software to help analyze if you need to pay any estimates, if you should pay yourself, if you're an SCorp, if you should pay yourself a bonus, so on and so forth. So it's very important to keep a P&L for these reasons. And as Matt was mentioning, if you were ever to be audited, having a clean records and having a balance sheet and a profit and loss would make it significantly easier for the agent to analyze your information and give you a no change if everything is clean and in the right order.
Yeah, and one thing we don't specifically have on here, but I think is extremely important, biggest mistake I tend to see from like new agents or new self-employed people is they don't save for taxes the first time because they have no idea how much to pay in estimated taxes. So, you know, you get used to the rhythm after you're doing it for a little while, and we can pay based on last year's or this year, depending on whether income is trending up or down or flat. But your first year, just assume half of the money that you retain after expenses is going to taxes, and shove it in a savings account and do not touch it. So I tell you, 50% is a good number. That might not even be enough if you're doing really, really well, but that's a kind of a good just general benchmark because it adds up. You have income tax, and like I said, you have the self-employment tax at 15.3% on the first 137 grand of net income. You can get over 50% with federal and California and the self-employment pretty quickly. So make sure you save for taxes, set it aside. All right, last slide here, strategies. This is the big piece here. This is how you really save money. So even before the Tax Cuts and Jobs Act, real estate has pretty much been like the #1 favorite industry in the tax code. You cannot get better than being in real estate. There's some other breaks, good breaks here and there, some oil and gas stuff. There's, you know, some tech stuff we can do, but real estate's always been big. Then along comes a real estate guy into the White House, and we just supercharged it with the Tax Cuts and Jobs Act. So real estate still is enormous in terms of your tax potential. There's a developer's credo that we say, which is just trade and trade and trade till you die. So you can keep deferring taxes and never pay them if you do everything right in real estate. When there was the whole big New York Times thing about Trump paying nothing in taxes and everyone thinking he was committing fraud or something, I was like, maybe not. You know, maybe just taking advantage of the rules that are in place. We didn't see the return, so we don't know, but there's a lot you can do. But before we get into that, #1, your income's really lumpy when you're a real estate agent or developer or anything in real estate. So if you have really good years, set aside and save, because you could have some real bad years too and nothing coming in. Don't go out committing to a bunch of major expenses and long-term costs just because you had one really good year. You know, we hope all years are good, but it doesn't always be the case. And I see a lot where, you know, people go crazy on the good years and then they're hurting come the bad years. So you don't want to do that. Cash is king. You always want to have a healthy cash reserve. You want to save that, have a lot of living and business expenses saved up for a long period of time. Usually recommend for most like regular people, 3 to 6 months minimum. If you're self-employed or a real estate agent, I'd be looking at a year or 2 years or even more if you can of cash just saved to make sure you don't get in a real bad spot if we encounter a big problem. That being said, the tax strategies, the QBI for high earners thing, that's a 20% deduction thing. That is huge. It applies without limit to the real estate income, whether it's rental income, whether it's, your agent income from selling properties, commissions, whether it's developer fees, anything kind of like that. The only limits are those wage limits we talked about, and or the combination wage and asset limitation. So you want to maximize for that, but you want to make sure you're getting the QBI. I just had a new potential client come across my desk this past week, and one spouse is a real estate agent that made a few $100,000, and it's a Schedule C, no wages, so they got 0 on the QBI. And if we do the SCorp thing, we're going to get a QBI of like 50, 60 grand a year, which means we're going to save 20, 30 grand a year in tax. And that's a permanent savings thing. That's not like a, timing difference type thing. So you got to make sure you're maximizing the QBI, which you can also get on passive income like rental income as well. Other strategies, tax rate arbitrage, just a favorite one of mine just in general for my clients, but also applies when you have lumpy income. If we're in a high income tax year and we're going to be in a higher bracket, we want more deductions in that year because we're in a higher bracket. Our bang for our buck on the deductions is going to save us more. If we expect next year is going to be a low income year, we want to try and defer income into that year. Or if this year's a lower income year, try and accelerate income. So we want to play the tax rate arbitrage game as much as possible, and any timing control we have over income and deductions, we want to make sure we're maximizing that when we have a difference in tax rates or when there's a tax law change. It's another big thing that happens. So we're looking at the possibility here of, Biden's administration raising tax rates on us in 2021 or 2 or whenever it may happen. We may want to bring more income into play now and get it taxed, and more deductions later because they're going to be worth more in the higher brackets. Family employment, this is a big one. If you have a spouse that's not working, or you have kids kind of in that like 13-year-old to 18-year-old bracket, you can employ family into your business. A lot of times we'll pay the kids. We'll pay the kids like $6,000 a year, for example. You can deduct all of the amount you're paying them as wages, as like an assistant basically on a W-2. So you get a tax deduction for that for income tax purposes and for the self-employment tax. A kid under 18 in the family does not pay any payroll taxes on their income. So you're not having any bleeding of the payroll taxes on that. They can make like $12,000 a year with a standard deduction and pay no income tax. So the kid's not going to pay any income tax on the $6,000 income they have. And then you can also take that money, you could fund a Roth IRA for them. If you start out when they're 13, 14, that could be a pretty big Roth IRA by the time they're a lot older. So you can start even funding retirement, or you can just fund a little bit and have them work and match it or whatever you want to do. But you can get a lot of tax advantage from employing your kids in your business, having it help with the business and do a little bit of work. Similarly, if you employ the non-working spouse and you guys set up like a 401k plan for your sole proprietorship, for your real estate agent business, the spouse, we can pay enough to fully fund a 401k. You can fund the 401k for yourself. You can maximize the retirement savings for the family by doing that. If they already have employment elsewhere and they already have a 401k, that one's not as important because you're going to pay payroll taxes on the spouse's wages, but the kids you're not. So we want to take a look at family employment if some of those situations apply to you. Vehicles and write-offs is a big one. I get the lease versus buy question all the time. Buying generally is good if we're buying an SUV style vehicle, the over 6,000 pound gross vehicle weight rating, and you're going to use it primarily for business. We can take basically a full write-off in the year we purchase it federally, which is big. It is a one-time move, so once that's written off, you can't write it off again later. If you sell it later, you're going to have income on the recapture, but it can be a nice big write-off kind of near year end if you had like a really good year and you need a new car anyway or something like that. That's a good one there. If you're going to buy a less than 6,000 pound car and it's a little more expensive, lease a lot of times gives you a better write-off because the depreciation on the car is limited for the under 6,000 pound cars, and it's sometimes not nearly as much as the lease payments are for like a luxury kind of vehicle under 6,000 pounds. So we want to take a look at it and see which one's better, but those are kind of like the general rules of thumb around vehicles and write-offs. You also want to make sure you keep a good mileage log. Technically, you're supposed to have a mileage log every single day. I tell people another easy thing to do is just keep a really good calendar where you go, and then you can always go back and recreate your log based on that. So whichever one works for you, but you want to have good records again in case there's an audit. I'll try and wrap up real quick here so we can get to Q&A. Retirement accounts, also very important. Big write-offs here. So SEP IRA is like the go-to and the common one for most people. It's very easy to set up. You can deduct 20% of your net income from your business into the SEP IRA, and the cap is like $56,000 a year or somewhere around that, mid-50s. So it's a good retirement plan for a self-employed person. It's very inexpensive to set up. You can set it up after the end of the year and have it applied to last year. There's a lot of advantages. If you have employees, you got to watch out because maybe you got to start contributing to the SEP IRA for them as well, and it limits the effectiveness a little bit. But that's the most common, easy one to do. But if you're not at that max out stage, a lot of times a solo 401k is actually a better choice for you than a SEP IRA. With a solo 401k, you set that one up. It's comprised of two components. There's the elective deferral piece, which is the 19,500 or the 25,000 number if you're over 50, that you can put in yourself dollar for dollar on the first 19,500 of income or the first 25,000 if you're over 50. Kind of like if you're employed at an employer somewhere to give you a 401k, you can take your own money and put it into that portion of the 401k. So if a SEP IRA, if you had 20 grand of income in your business, you can only put in $4,000. With a solo 401k, you could put in $20,000 or 19,500 because you're not limited by that 20%. You can do dollar for dollar on the first elective deferral piece. And then above and beyond that, you can put in the employer match piece, which is up to the 20% of what's left on the income. And they cap out around the same place, the $56,000. But if you're kind of below the max SEP threshold area on income, but you want to put in more, the solo 401k may allow you to put in more than the SEP IRA. There might be a little more fees, but not very much for a solo 401k, and a little more complexity, but otherwise it's also very easy to do. One distinction being you got to set it up before the end of the year, not fund it, but at least establish the plan. Then you can fund it before you file your return at the end of the next year. And then if you want to go beyond those, you can really supercharge. There's stuff called like cash balance plans and that kind of thing where you can shelter 6 figures pretty easily. The amount you do is a function of how old you are, your age, and your income. The older you are, the more you make, the more you can put in. I got clients putting in $300,000-$400,000 a year into those things. So you can really maximize those as a really big write-off potential if you're making a lot of income and you're closer to retirement. But those are obviously going to be more expensive. So important to think about. Last one here is the real estate professional advantages. This again is one that applies to you guys that you really need to consider, is that normally when you have a rental property and you have a tax loss because of depreciation expenses and that kind of thing, it's considered a passive loss for most taxpayers. Any passive loss is supposed to be suspended, and you can't use it in the current year unless you have other passive income. If you don't, then it's suspended and carries forward to future years. If you're a real estate pro, those rules don't apply, and you can actually take any net tax losses on your long-term rentals and you can offset your current active income. So actually, by building your own personal portfolio of rental real estate, whether it's residential or commercial, doesn't matter, as a real estate pro, you can take those tax losses sheltered by depreciation and you can use those to offset your current active income right now, at least on the income tax side. We can't shelter the self-employment tax piece, but we can shelter the income tax piece, and that can make a big difference. And that's the thing where I think people like Trump get a lot of write-offs. They have these large project with big depreciation expenses, and there's ways to accelerate depreciation with stuff like cost segregation studies. You can get big write-offs in the beginning, shelter your current income. If you start showing income after running through most of your depreciation, go buy a new property, get new depreciation, start over, and just keep going. And then, as the equity builds on the assets, you can, trade into new properties and 1031 exchange without paying taxes. If you need cash and you got a lot of equity, you do a cash out refi, take the cash, that's not taxable to you. And so this is the way you can just keep kind of building the empire, trading, and basically just keep kicking the can on taxes and deferring. I mean, the piper gets paid at some point, but if you stay under the estate tax limit, by the time you pass away, you may pay no taxes. So again, it's kind of the trade till you die thing I was talking about in the beginning, where you can really kick the can for a long period of time. The extreme example, but can be done. So I will stop sharing my screen and let's look at the Q&A. We got quite a few questions here.
Matt, I can actually read them off for you.
Perfect.
If you want. Okay, perfect. And then I also want to mention, just because there's everybody's now on the call, is that Matt is actually our market center CPA as well. I've been doing this for about 12 years. I've built numerous Keller Williams market centers along with managed numerous groups and teams, and he is by far the best CPA I have ever known. So he is great. If anybody needs a CPA for 2020 taxes, he's your guy. So I just want to make sure everybody knows that, because I vouch for you, my friend.
Appreciate it.
If I may jump in too, Stacy, just add to that. I've been looking for an accountant forever, and you'll find most accountants are really good at just kind of bookkeeping and filing your taxes. But when it comes to strategy, Matt and his team, they really take a step back first and look at your entire financial portfolio and decide what works best for you. And to find a strategic accountant is extremely rare, extremely rare. So you're in good company. I highly recommend him as well.
Yes, and KWSCV definitely always hangs out with the best. Okay, so first question is from Alan. On the home office expense, when you sell the house, the depreciation gets paid out at that time. How do you decide between the annual write-off versus the depreciation we capture later?
It's a good question that we do see a lot. Depreciation is technically a use it or lose it thing. Technically, if you don't claim it in the years you're entitled to it, they would still reduce your basis on the sale and you would have a gain at that point anyway. So we always advocate taking it. But you also want to take it again because of the rate arbitrage. If we can take it now and use that home office to shelter your current sole proprietor income, you're going to save on the income and the payroll tax piece on that at your current tax bracket. And the recapture only comes back at 25% flat federal rate. So you have some differential savings there on the arbitrage anyway. So yeah, you pay it back a little bit, but you get the permanent rate difference and you get it now versus later.
Perfect. Okay, next question is from Linda. On vehicle expense, do you have to keep track of mileage?
Absolutely. We got to keep track of the total mileage in the car. So usually recommend like taking a picture on January 1st and taking one again the next January 1st. So you have the total, or otherwise they go by like oil change receipts or that kind of thing. And then you want to keep track of the amount that's business related. That's why I said you're supposed to keep a contemporaneous mileage log. That's the IRS rules. I haven't had a problem where we go into an audit with just a spreadsheet we recreate in advance of the audit once we know we're getting audited. But my recommendation then is make sure you have a good calendar you can go reference back, because you can go see, okay, I went to these 3 houses that day, and then you can kind of go recreate the mileage from there if you have to. But yeah, you need to track mileage. Whether you claim actual expenses or mileage, you must track mileage either way.
Got it. Okay, this one is from our agent, Myrna. If you rent and you have a home office at home, can you still make the deduction?
I'm going to interpret that as asking if you rent an office somewhere and then you also have a home office at home, I'm guessing is what the question is there.
Seems like if she's saying more if you're a renter and you have a home office, can you still take the deduction?
I'll answer both questions then. Absolutely, on that one. You can claim the same prorated amount of your rent as you could as the mortgages and taxes. So it's the same calculation, square footage of the office divided by square footage of the entire home, and that times your rent. So you can still claim the rent for sure on a home office. And then the other part was if you happen to have, because this kind of comes up too, you're renting somewhere an office or a desk or something, and then you also have your home office you primarily work out of, there's some more nuanced tests involved, but basically wherever you perform like the bulk of your work and like the administrative duties, or you meet with clients regularly, which doesn't happen for you guys, but for the administrative piece, if you're doing that at your home office, that can be your primary home office, which is hugely important, because if it is, anytime you leave your home office to go somewhere, that's now a business trip. If you have an office somewhere else, then leaving your house is not a business trip. You got commuting mileage first, and then you have business mileage from your business location to wherever you're going. So that becomes a distinction there.
Perfect. Okay, next question is, if you have a networking event for all the clients, can the expenses for the food, drinks, rent be deducted?
Yes, you can. And Nick, what's the, is that a 50%er or a 100%er?
Let me look that up while you answer some of the other ones.
So usually the meals we limit at 50%. There's some rules where we can do 100%, like if you're doing an office party. If Alan hosts a party for like everyone in the Keller Williams thing, that's 100% write-off because it's not considered to be like a entertainment deduction with the clients under the 50% rules. I believe a networking event like that's going to be a 100% thing also, but it might depend. I got to check. That's because that one's a little more complicated.
Yeah.
So we'll get back to you. But yeah, you
Okay.
can write it off. Just the question is whether it's half or full.
Perfect. This one is from our agent Yvette. What is the cost to become an SCorp? Are there ongoing costs?
There's going to be some sort of incorporation cost. You can go cheap and go like the legal Zoom kind of route, which may be work, but you're still going to probably be paying a few $100 or $500 maybe for that, 500-600. Or if you hire an attorney, you're probably looking at starting at 1,500 or so for forming an S corporation as an incorporation cost. And then, yeah, the ongoing costs, like I mentioned, are tax preparation costs every single year for the corporate return. You're going to have payroll costs now, so a payroll service. Usually the tax prep cost is going to be, you can maybe find someone on the real low end for 1,500 or 1,250 or something, but it's probably going to be more like 2,000-3,000 for the S corp return. And then payroll is going to run you with the least expensive options around like $40-50 a month, something like that for payroll, so around 600 a year or so. So like I said, they do add up, and we factor that into the analysis and figuring out if it's worth it or not to do the S corporation. So there are some ongoing costs. That's why I say again, kind of around 200,000 net income or more is where it's starting to make a lot of sense financially to look at making the switch.
Yeah. Okay, another question from Linda. You mentioned earlier keeping business and personal expenses separate. Would you file separate as well?
Well, if you're a sole proprietor, then you're a Schedule C, so you don't file anything separate. That goes on your regular personal tax return as part of the personal tax return. There's no choice to file separately there. If you have an S corporation, that's going to be a standalone taxable entity. It's going to file its own return. And then there's going to be some information flowing into your personal return, the pass-through income, but you would have a separate return in that case. And if you're talking about separately or joint with your spouse, a couple of things there, but number one, California is a community property state. So basically, even if you file separately, unless you have a prenup or something, you got to report half your spouse's income and deductions, and they're going to do the same thing. So there's usually no sense in filing separate. Usually we file joint, although we do have some tricks. If you're making over $1 million a year, we do file separate, but that's, if you're at that point. And if you are, you should be talking to me.
Perfect. And then from Conrad, what is the easiest way to track mileage? Yeah. What is the easiest way to track mileage?
There's apps that you can do out there. You can do a little book in your car. You can do the calendar thing, like I said, with the spreadsheets. It's about diligence more than like a best way and what's easy for you. Some people just easiest thing for them is to have the little book in the car and write all the trips down as they go. Some people do it in a spreadsheet every like once a week or something, and they're pretty diligent. Other people use the app, but if you don't start and stop the app at the same time, of course, you're not going to, remember to track all the mileage. So there might be some newer apps out there that are doing some of it more automatically for you. I don't know. I haven't looked at that in a little while. But
actually, Alan and Offer and Yvette all say they use MilesIQ app, which is really easy for tracking mileage. They just posted that.
Boom.
MilesIQ. So Conrad, MilesIQ, download that app. And then he asked, can I use out-of-state properties on my Fed and California tax returns?
Yeah, you can have out-of-state properties. So on federal, it's all going to factor into your total income. And if you have out-of-state rentals and those are generating tax losses because of depreciation and stuff like I mentioned before, you can use that to offset your income. As a California resident, you're taxed on your worldwide income just like federal. So the same thing, you would see benefit on out-of-state losses against your California income. If you have out-of-state income, then you might be having to pay tax in different states, and you would get a credit on the California return for tax you pay out of state. It should kind of wash out for the most part. But yeah, you can have out-of-state properties.
Alan asked, if you lease a car, is the whole amount written or by percentage? or how much mileage tracking is needed in the lease scenario?
We still need to track mileage because we take that total mileage for the car and we take the business mileage. That gets us our percentage or our proration. And then we apply that to actual expenses if we're doing lease expenses, the lease payments, and then we can write off that percentage of the lease payment. Or if we're just doing the mileage method, you have to know the business mileage anyway to get the business rate per mile, which is like 57.5 cents per mile, I think. So you got to track the mileage either way to figure it out. And then if you're leasing, then you want to do the actual expenses. We take that percentage times the lease payments and times gas and insurance and everything else you're paying for.
Okay, and we just have two more questions. One from our agent Raymond. You mentioned to have 3 to 6 months reserve in cash. Do you mean both business and personal expense or just personal expenses? Or do you recommend a line of credit in lieu of the actual cash?
I'd say minimum 3 to 6 months, probably more. Again, if you're a self-employed agent and that's your primary source of income or a large source of your income. And the reserve is in terms of like your ongoing fixed expenses. Anything that you could scale back, you know, if the income stopped coming in, you would start cutting expenses that you can scale back. But your fixed costs, like your housing and groceries and some of those kinds of things, as well as any fixed business costs, like your lease payment on your car or whatever, you want to factor those into your calculation of how many months, and you want to have, maybe even a year or more. A line of credit's good, and it's nice to have, but you need to be careful there, and you can't just count on that always being there. We saw in the Great Recession back in 08, 09, when the going gets tough and your line of credit's paid off, the bank started calling off lines and canceling them, So, and all of a sudden you can't access that equity in your house when you need it. So, when the pandemic first started hitting, you saw a lot of businesses all around the country start drawing on their lines of credit immediately. They didn't even need the funds. They just drawed on them, put them in cash. That way they knew it couldn't be canceled on them or reduced or something else. And they just kept that cash there just in case. So the same thing that they do, you should think about doing. If you got a line of credit and all of a sudden the S hits the fan, pull the money out, sit there. Sure, you pay a little bit of interest, but you have liquidity now that they can't take away if you need to, pay for something or whatever. So line of credit is good. Just don't count on it being there if you haven't drawn on it and something starts to go south. So having the actual cash is better. Having the line of credit's also good. And there are ways to be tax advantageous with our borrowing and how we use the funds to maximize our write-off potential there, which again kind of decreases your effective cost of borrowing as well.
Okay, perfect. Okay, so, and then this is a good question. What's the best thing we could do to help our CPA have everything they need to easily find the best scenario for us?
Well, you can, having good records and everything really clean obviously helps make the return preparation process easy, and that'll help keep your fee down on the actual return. If your CPA is not that proactive on coming up with strategies and stuff, I would start by requesting like a planning appointment separate from the preparation, and do it maybe near the end of the year like this, and then ask the questions. What can I be doing? What should I be doing? See what answers they come up with. Talk about your kind of like, your near-term plans, but also your 3 to 5 year plans and your longer-term plans. And if they got nothing for you and say it is what it is, leave them and call someone else like us.
That's a great answer. Okay, last question. As a new agent with expenses but no income yet, would you still deduct expenses?
Yep, as soon as you're open for business trying to get income, you can start deducting expenses. So even though the first year you might have no income, you have expenses, you still want to claim those all. You can use it to offset your other income that year from maybe you were a W-2 before you changed jobs or something, or you have other income. Or if you end up just having net losses, you may have a loss that can carry forward to the future to use in future years. So you can definitely claim them as soon as you start working and holding yourself out for business. And the same goes for like a rental property. If you get a rental, as soon as you start putting it on the market to try and get renters, that's when you can start writing everything off. You don't need to wait till you get income.
Perfect. Well, thank you so much, Matt and Nick. I love you guys. You guys are the best, and you are our office vendors. So we really appreciate you guys and all the help you provide us here at the Santa Clara Keller Williams office.
Love it. Thanks again, Alan. Thank you. Really appreciate it.
Matt, thanks.
Thank you, everybody.
Thank you.
Thanks. See everybody later.